QYLD has serious risks that I think most investors just aren't aware of. There are 5 of them that I'm going to go over in this video, but the first one, which is the options losses, I think is something most people are totally in the dark on. And that's why this video is going to be different from the other videos on QYLD that you're watching. I'm going to show you some information that's really going to make your head spin. And you're not seeing this in other places, so stay tuned. You're going to learn a lot. It's going to be a fun video. The stated goal of QYLD is to generate income through writing calls, options trading. But what if I told you that in 4 of the last 5 years, they've lost massive amounts of money trading options? They only made money trading options in 1 year out of the last 5. Let's take a look. Here is the statement of operations for the QYLD ETF. It is very clear when we look at the written options and purchase options line that they are not making money by trading options. You can see in 2020 a $389 million loss on written options. Then again in 2021, $241 million loss writing options. 2022 they made a profit. Then in 2023 we have almost $1 billion loss on writing options. And in 2024, they have a loss on writing options, and we know that by looking at the distribution rate for the year. When your stated objective for the ETF is to generate income by writing call options, but you lose consistently by writing call options, I think there's a problem. The reason most investors don't know about the options trading losses and how spectacularly bad QYLD has been at trading options is because of the monster distribution, which is almost entirely a return of capital, i.e. you're just getting your money back. It's not a dividend yield, right? It's not a dividend, rather. You're just getting your money back. It's silly. And the rise of the underlying investments is also masking the losses on the options trading. But it all comes at a price to you. Let me show you. Because QYLD has a ridiculously high distribution yield, they end up distributing capital back to you. So this is what has happened if you invested $100,000 in QYLD back at inception. You now have capital left of $75,000. That is because they routinely and continually distribute capital back to you, i.e. you're just getting your money back. But many people don't know this because they're unaware of the fact that QYLD is losing money oftentimes on their options trades, and they're not seeing those losses because the underlying investments are going up, right? The rise of the underlying investments is masking the fact that QYLD is not very good at trading options. When you aren't making money on your options trading, you don't have any gains to distribute. And that is why when you look at the QYLD distribution data, we're looking at the distribution worksheet for October 2024, you see return of capital right here, 97% year to date. $3.57 per share of distribution. That's your monster distribution yield. 97% of that distribution has been a return of capital. That's because they're losing on the options trades. The return of capital presents a serious issue for retirees using this investment for income, or anyone using it for income for that matter. How do you know what you're getting is income versus principal? You need to have a sophisticated accounting system throughout the year to maintain a record of what is principal coming back to you and what is income, so you don't spend your principal. In my experience, many people are unaware that they are getting a return of principal and they spend it. They mistakenly confuse the monster distribution on QYLD and others as income when it's not always income. In addition to the risk of accidentally spending your principal because you think it's income when it's not, you also run the risk of market timing. When you have a covered call ETF that is distributing capital back to you, especially on a monthly basis, you are now out of the market with that capital. Even though QYLD has had a number of years with realized losses on the options trading, the fund has still been able to deliver positive bottom line total return numbers to investors. And that is because the unrealized appreciation of the investments, the stocks they hold in the portfolio that they're writing calls on, these investments have gone up by a significant amount in a number of years. 298 million in 20, 948 million in 21, $1.9 billion loss in 22, and then a $1.8 billion gain in 23. So when the options trading strategy is losing, you're hoping that the stock holdings are going up in value. Some people find this appealing. I think in the long run, the options trading is going to hold you back and tamp down your performance. We're going to see that later on in this presentation, but some people do find the options trading to be a benefit. The third major risk for QYLD is that you have capped upside due to the covered calls, but you still have significant downside risk. You can lose a lot of money in QYLD. Let's take a look at the returns back to 2014 compared to QQQ, the NASDAQ 100 underlying index that they're writing covered calls on. You see that most years there is a big performance gap where QYLD is underperforming the QQQ index. For instance, in 2020, QYLD was up only 8.74 when the triple Qs were up over 48%. That's almost 40% differential. Huge opportunity cost with QYLD. Same thing happened in 2023. 32% behind the QQQs. And then in 2022, when the QQQs had a big slide, QYLD was still down 19%. The end result of capping your upside over a long period of time, but still having significant downside exposure, is that you end up with a poor performance over time. And I would also show that in 2018, QYLD did worse than the underlying index. So you have that. It is possible that QYLD can perform worse on the downside as well. Capping your upside, but still having the potential for significant losses, results in a poor risk to reward profile. We're looking at a scatter plot for QQQ, SPY, QYLD, and the Vanguard Balanced Index Fund, a very basic 60/40 asset allocation fund. What jumps out is that QYLD has more risk when measured by standard deviation, i.e. volatility, than the Vanguard Balanced Index Fund, but lower returns. Not a pretty picture. Then we compare QYLD to the QQQs or the SPY, S&P 500, and you can see that while they have more risk in terms of volatility, they give significantly higher return. So QYLD is in the zone where it's offering you an unattractive risk to reward profile. Over time, the capped upside on QYLD and the poor risk to reward metrics can catch up to you. Here's what would have happened if you put $100,000 in QYLD at inception and compare that to $100,000 in the QQQ ETF or the Vanguard Balanced Index Fund, a very basic 60/40 asset allocation fund. If we did total return for all three investments, reinvesting dividends, by late 2024, we would have $240,000 in QYLD versus $250 in the Vanguard Balanced Index Fund and $670 in the QQQs. So this gap between the QQQs and QYLD, that's what happens by capping your performance. Additionally, when you can't even beat a 60/40 basic asset allocation fund, but you still have significant loss potential, I don't know how this is an attractive investment. Now, to be fair to QYLD, the last 10 years have been the worst kind of environment for a covered call fund. As the underlying investments keep going up and up and up, the fund keeps getting called out of their positions, capping their upside. The best kind of environment for a covered call fund like QYLD is a market that just goes sideways. In a sideways market, a fund like QYLD can write calls, keep the premium, and possibly outperform the underlying index. However, these situations tend to be short-lived. In the long run, the stock market has a history of going higher. We're looking for capital appreciation in the long run. So if you plan to hold a fund like QYLD for a long period of time, you're probably going to have your performance hamstrung by the covered calls. If you could only know what the market movement is going to be in the future, then you would know when is it a good time to own QYLD or not. But that's a tough call to make. The annualized total return for QYLD since inception, 8.13%, 7.88% on NAV as of November 30, 2024. Compare that to their distribution November 30, 2024. It's 12.13%. Right away, it should become apparent that, wait, we're distributing 12, but we've only been earning 8 historically. Something's not right here. That's because you're getting your capital back, right? This just reinforces the return of capital, which is silly in my opinion. Compare this to QQQ total return since inception of QYLD. What do you see? 18.73% total return. So you're about 10 points behind on an annualized basis. It's a huge difference, and it really begs the question, why would you want to use QYLD for total return? The fourth major risk for QYLD is that the fund has high fees with mediocre returns, 0.61% annual expense. Fees matter when you don't have big returns. In addition to that, notice the 30-day SEC yield is only 0.26%, but the 12-month trailing distribution is 12.15%. Here again, highlighting the fact that there's very little true income in the portfolio, but a large distribution, and that's because we're getting return of capital. The fifth major risk for QYLD is taxation. QYLD does not receive qualified dividend tax treatment. Instead, the options premium and any income in the fund that is generated is paid out to you as ordinary income or long-term capital gains. So you are at a tax disadvantage with QYLD if you own it in an after-tax account. Preferably, you want to own QYLD in a tax-free account like a Roth IRA or a tax-deferred account like a standard IRA. If you own QYLD in an after-tax account, you're going to be at a disadvantage versus owning a standard index like the S&P 500 or Russell 1000, both of which can qualify for long-term capital gains tax treatment and qualified dividends tax rates if you hold them for a long period of time. If your financial advisor isn't talking to you about the risks of covered call funds like QYLD, please give my office a call. We would be happy to give you a second opinion on your investments. So let's add it all up. QYLD is an investment that if you hold it for the long term, you are likely to make money. The investment has a long-term track record of total return performance just over 8%. So you can make money on QYLD in the long run. However, there are some risks that you want to be aware of. Number one, the options trading strategy in QYLD has been a drag on performance. It caps the upside, and in a bull market, it's going to hold you back. Number two, the return of capital is why the distribution is so high. I think the distribution at 12% is silly, but that's the strategy that the managers of QYLD are using, and they're returning principal to you. You have to be careful with the return of principal, return of capital. Make sure that you're not spending your capital and you're only spending the actual income generated by the fund. Number three, your upside is capped, but you still have significant downside loss potential. Number four, the fees are high. Number five, taxation is very complex, and you are likely to end up paying ordinary income on a lot of your returns over time. The best place for QYLD in a portfolio is going to be somewhere between stocks and bonds, and you're going to be using it when you need income. However, you want to be sure that you own QYLD in a tax-deferred account or a tax-free account. If you are using QYLD for income, make sure that you are tracking what is return of capital and what is actually income. You don't want to get yourself into a situation where you're spending your principal and you don't know it. I hope this video was helpful. I hope it gets you thinking. helps you better analyze your investments and overall improve your family's financial plan.